I'm Jeni Browne. Welcome to MFB News. Hope everybody is really well and you haven't melted. It's been so hot, isn't it? Actually, I was moaning it's cold. I've now been moaning it's too hot. I think today it's going to be another warm one. It's Wednesday morning. What time is it? 7 o'clock. Currently raining. Perfect. I one day will just start this video saying, isn't the weather nice today? But not yet. Now, in terms of what we're going to cover for you this week, guess what, guys? We're going to talk about swap rates. We're going to talk about what lenders have been doing, their pricing, and all the kind of stuff we like to do on repeat because it's important. Then what we're going to be doing is having a look at loads of other new news items, all of which are really, really relevant to you as landlords. So we're going to be talking about, she says, looking through her notes, what's going on with house prices, how long it's taking to sell a house at the moment. Believe you me, from first-hand experience, it's not easy. We're going to be talking about inflation, we're going to be talking about EPCs, and also we're going to be talking about the Renters' Rights Bill. So loads of stuff to cram into our episode this week. Okay, so kicking it off with swap rates and what's going on there. So 2-year swaps as of 10:45 Tuesday night. 2-year swaps 3.58, 1 month ago 3.8, and 1 year ago 4.49. So actually, month on month, and that's probably the sort of most important thing, we have seen a reduction in 2-year swaps of sort of circa 0.25%, which is quite good. 5 years, similar story. So currently 3.61. 1 month ago 3.81, and 1 year ago just over 4%. So again, a reduction of sort of circa 0.2% month on month. What does this actually mean for you as borrowers? So what this means is that actually lenders' cost of funds has come down by 0.2, 0.25, depending whether you're looking at 5 or 2-year swaps, which does then mean that actually there is wiggle room should they wish to take it. And lenders are very good about this actually. They do tend to pass on the reduced cost of funds. They just need to make a set margin. So whatever the cost of funds are, then they need to make the same percentage above. It's sort of like a tracker almost. So they do pass on any reduced cost of funds, which is fantastic. So that means that actually for lenders who haven't repriced downwards in the last week, actually this does leave the door open for them to bring things down a bit. So how has that kind of fed through to mortgage pricing in the last week? We've seen a little mini wave, let's call it, of rate reductions. Why have we not seen more? I suspect because for those of you who don't watch this regularly, can't imagine why you wouldn't, actually rates have come down, swap rates have come down by sort of circa 0.1% week on week. 2 weeks ago to last week, and they've come down again by circa 0.1% to this week. So actually it's a very kind of slow decline. So what some lenders probably said is actually swap rates came down by 0.1%. Is it really worth repricing a whole mortgage product set? We think they're going to move again. Let's just wait and see. So I suspect actually lenders aren't rushing to drop prices down, not because they're mean, but just because actually repricing a whole set of mortgage products, and some lenders have hundreds, it's quite time consuming, it's quite expensive. And if they're going to then reprice again downwards shortly after, one could argue the most efficient thing is just to sit and wait. So what have we seen? We've seen Leeds bring their limited company rates down by up to 0.3%. Leeds in the limited company space, they're really competitively priced. There's no escaping that. It is quite hard. They're not the most flexible lender, let's say. It's not hard to get a mortgage with them, it's just their lending criteria is quite rigid. So if you have a limited company, just to be super stereotypical, husband and wife, and you're the only shareholders, and you've got a little portfolio in the background which is not highly leveraged, looking to mortgage a very, very straightforward property, these guys could be a really good solution for you. Unfortunately, most of you don't have those really simple structures. You're not financing really straightforward properties, or you have loads of properties in the background. So a lot of people can't actually get at the pricing from people like the Leeds. But for those of you who can, and there's a real contingent, very good. Coventry brought some of their rates down by up to 0.15%. This is on their non-limited company range now. Very good lender, up to 10 mortgage properties in the background, no minimum income, pretty good at older applicants actually. They tend to be more loose on their age limits, looking to lend on very standard properties. So nothing racy for those guys. Interestingly, one of the things you can do is Coventry, if you've got up to 4 people sharing, so it could be classed as an HMO because you've got unrelated households in a property, but they're all on one single tenancy agreement. Coventry could be a home for you there, so rather than paying HMO rates. BM Solutions rates down by up to 0.24%. Large lender, people watch when BM Solutions make chunky price drops like that. BM Solutions, I mean, if I say the sort of criteria for Coventry and then just like, you know, photocopy it for BM Solutions, it's the same kind of lender. The Principality rates are down by up to 0.1. We don't do a lot with Principality, if I'm brutally honest. Why not? Because they're never that competitively priced and their lending criteria is quite strict. One of the things that they have been very good on in the past is holiday lets. And finally, Molo have brought some of their rates down by up to 0.2%. Molo, new lender, very, very good, lean very heavily on technology to process their applications, which can make for a really nice experience. If paperwork and being asked to provide documents gets on your nerves, which is like all of us, I think, their criteria is good. They're looking to kind of really support the landlord community. So they're doing personal stuff, limited company stuff, larger portfolios. And they've got some really quirky bits of lending policy. So as an example, one of the things they're quite good at the moment is expats. So lots of good stuff there. So to summarise in the round, we have seen a little wave and a range of lenders actually. We've seen some kind of more clearing banks and some more specialist lenders bring their pricing down in the last week. I suspect we're going to continue to see this kind of slow kind of evolution of pricing if swap rates kind of continue to do what they're doing. Obviously if swap rates go up, everything's going to go in the wrong direction. So let's hope Donald Trump keeps his mouth shut for the next few weeks and we can end our summer terms before the summer break on a nice quiet note. Okay, a little quick bit of lender criteria change which comes from our friends at Fleet Mortgages. Now Fleet are a specialist lender. They are very competitively priced in the limited company space, so they're very good with people with, you know, large portfolios, so no maximum number of properties in the background. They can do limited companies, HMOs, multi-units, all that kind of stuff. They are owned by Starling Bank. They weren't originally. They got bought by Starling Bank. So for those of you probably who have kids, you'll know about Starling Bank accounts. Tends to be like the next stage on from a Go Henry or something. I also have a Starling Bank account, by the way. It's very good. But so they've kind of moved from being kind of a very sort of new lender who was quite flexible to being slightly more rigid in their lending policy because they're owned by a much bigger institution now, essentially. But one of the things that they were quite particular about is the limited company itself and the kind of structure of the limited company. So essentially Fleet have always had the position that they will only lend to a limited company which is owned by people. So it has to have, the shareholders of the company have to be people rather than another limited company. And this actually would be more of an issue than you would think for those of you who have very standard limited company structures or are thinking about going into limited company ownership for the first time. Obviously you would be thinking, well, hang on a minute, of course I'll set up a limited company which is just owned by me. But actually it's very, very common to have limited companies which are a subsidiary, so part of a group of companies. So you have a holding company which then owns the SPV, but the holding company may also own other companies as well. Why are these sort of structures so common? So the first thing can be if the borrower, so the applicants are a trading business. So say for example, they have their own IT consultancy and they want to then use some of the profits that they've retained within the business to buy a buy-to-let. One of the ways you would do that to avoid having to withdraw the money from the trading company to your name, pay tax on it, to then re-lend it to the SPV. If there's a holding company in place, you can kind of move money around the group without getting taxed on it. So that's one of the reasons. Another reason might be, an example would be if you own the freehold of a building and leaseholds, it might be that you have a separate company, which is a freehold company or a managing company for the freehold, therefore you put them into a group. So there's all these different reasons, so it's more common than you would think. So it's really great that Fleet have now revised their position and so actually we are able to accept holding company structures. So we can lend to an SPV which is owned by another company. Are they the only lender that does this? Absolutely not. We've got some really big hitters in the limited company space, people like Paragon, Kent Reliance, Foundation Home Loans, TML. These guys can all accept this stuff standing on their heads. But actually what's really nice is that Fleet do tend to be one of the more competitively priced lenders. So it's great to see them come in and make actually what I see as a fairly seismic change in terms of their lending policy, really opening up their doors to more landlords. House prices for you now, and Nationwide have released their latest house price report, which says that house prices rose by 2.1% annually in June, which is down from 3.5% in May. So essentially the rate at which house prices have grown year on year has gone backwards. So what they're saying is that on a monthly basis, prices slipped by 0.8% after seasonal adjustments, bringing the average property price now to £271,619. Now, Rob Gardner, who's a sterling chap, he's the chief economist at the Nationwide, has pointed to several indicators supporting housing market activity. So essentially saying, actually, don't read too much into this headline. There's a lot of good stuff going on. So he said that the unemployment rate remains low. Earnings are rising at a healthy pace in real times, i.e. after accounting for inflation. Household balance sheets are strong and borrowing costs are likely to moderate a little if bank rate is lowered further in the coming quarters. And we and most other analysts expect that actually house prices will actually start to gain momentum throughout the summer and into the autumn. So if you are waiting on your hands for house prices to soften a bit, we all know that houses are quite hard to sell at the moment. More on that in a second. But actually maybe it could be that we're at the point now where this is the real negotiating time before the market starts to gain momentum a little bit. Now, in terms of the data for regions, so Northern Ireland remained the strongest performer by a wide margin. Now, it did see a slowing in annual price growth to 9.7% from 13.5% in quarter one. Scotland recorded a 4.5% annual rise. Wales was 2.6%. Now, across England, annual price growth stood at 2.5%. So of the kind of various countries, as it were, England is performing the lowest. A modest decline from 3.3% in the first quarter. The difference in performance between the northern and southern regions actually narrowed slightly. So Northern England, which covers the north, northwest, Yorkshire and the Humber, East Midlands and West Midlands, saw house prices rise annually by 3.1%, whereas basically anything below that recorded an annual increase of 2.2%. So basically us in the southeast are dragging the whole thing down. So that's quite interesting just to know that actually house prices are slowing a bit, but actually the economists, they're not worried about it. They're saying that actually it was to be expected after the stamp duty cliff edge finished. People had fast forwarded plans to buy. Now we've got that kind of gap while the market then kind of rebalances itself, but actually they're expecting things to really start to pick up. So like I said, if you're thinking about buying, this could be a very good time. Now also, as I alluded to earlier, there's some analysis that's been released regarding how long it's taking to sell properties in the UK. And the report that I read recorded data across the 50 largest cities in the UK. I didn't even know there were 50 cities, to be honest. That's huge, isn't it? Anyway, basically it's showing that the duration to sell a property ranges as an average from 36 days to 150 days. So it's a massive disparity. So if you're thinking about selling properties, the good news is if you're based in Glasgow, you're going to sell your property the fastest at 36 days. Dundee 59, Edinburgh 71. Interestingly, all in Scotland, that's got to somehow be connected to the way that they do property selling in Scotland, surely. In England, we have Northampton in 4th place and Newcastle at the 5th place with 80 days to sell a property. Bad news, if you're located in Aberdeen, your properties are taking 150 days to sell on average. That's the average as well. Can you imagine what the longest is? Bournemouth, 143 days, London, 139, Luton, 132, and Brighton and Hove, 130 days. So actually we can see that in some parts of the country, in some cities, it's taking a really long time to sell properties. So maybe these are the cities where there's really scope to kind of go and have some negotiations in terms of price. Further insights that were shared in this report, just because I think they're quite interesting because I'm a massive property nerd. A collapsed sale cost buyers £2,500 on average, including mortgage application fees, surveys and solicitor costs, but this can vary dramatically. So if you're buying a property in London, your average cost for losing a purchase is £3,500, whereas if you're in Wales, it's £1,800. So that in itself should be a kind of real motivation for buyers to keep going with their purchases, but apparently not, because actually almost half of all sales fall through because simply one party has had second thoughts. They've just changed their mind. This is especially common in Norwich, where almost 2/3, 62.5% of failed moves were due to people simply getting cold feet. So there you go, a bit of insight into what's going on into the property market, just to kind of say with a kind of more first-hand experience. I'm trying to sell a property, and I've mentioned this previously. It's very, very hard. It's very quiet in terms of buyers. All this whole kind of landlords have got all the properties that first-time buyers want to buy. I can categorically tell you that simply isn't true. I'm selling a 1-bedroom flat in Tunbridge Wells, perfect first time buyer territory here. Is there a rush of first time buyers looking to buy it? No, there isn't. And I'm hearing similar things from other investors as well. So actually, it is quite hard to sell a property at the moment. The good news is, in the kind of reverse of that, if you are thinking about buying, there is some real opportunities available for you to negotiate nice and hard on purchase prices, just not on 1-bedroom flats in Tunbridge Wells, please. Now, I listen to a podcast religiously called The Rest is Politics. It's really, really popular. I'm sure a lot of you have kind of already listened to it. But if you don't, it's really worth listening to. It talks about a lot of kind of stuff that's going on in the UK and also the world. And while it is politically leaning, actually, it kind of talks about loads of stuff like war and things like that as well. So it's really, really good. Free to listen to, very interesting. But the thing that kind of caught my attention was they were talking about actually how climate change is going to impact lots of things in the world. And one of those is food inflation. So it was very, very interesting that I saw a note that came around saying that UK food prices increased in June by 3.7%, which is up from 2.8% in May, the highest rate of increases since March last year. And this is according to data from the British Retail Consortium. Now, the reason I kind of link this back to climate change is that the BRC had said the hot, dry weather was impacting harvest yields and had contributed to the price rises. So overall, shop price inflation, which does include non-food items, was up 0.4% in the year to June, following a 0.1% decrease in May. So essentially, things in the shops may be starting to increase, and this can be attributed, at least in part, to the weather and what's going on there. For those of you who are interested in this kind of stuff, actually, Clarkson's Farm was a real eye-opener for me. Do I sound like I just spend my life watching TV, listening to podcasts, don't know, which is probably true actually. But Clarkson's Farm was really interesting to watch, to see how actually the weather has such a huge impact on farming and food production, and how with all the kind of stuff that's going on with climate, for those of you who believe in this kind of thing, actually this has a knock-on impact to food production globally, and this will therefore have an impact into inflation as well, which ultimately, as we all know, kind of really bizarrely feeds into what's going to happen with your mortgage costs. So definitely something to keep your eye on there. Now, the Mortgage Works released a report on EPCs in the last week, and there was a bit of sort of summary data in there that kind of horrified me actually. So the data in the report was derived from surveying 1,000 landlords, quite a lot of you, to offer a deeper understanding of the challenges landlords face in tackling the energy efficiency of their properties. And that's all very, very commendable. And it was a really interesting report. And if any of you want to read it, I'm very happy to send it to you. You can either email us, inquiry@mfbrokers.co.uk, or you can leave a comment and we'll just send the report over. But the bit that kind of really caught my attention, and this is where I think we as landlords need to be really supporting our landlord community, is that 62% of landlords who responded, so that's 620 landlords who just replied to this one survey, didn't know that having an EPC certificate for their property was a legal requirement. Which absolutely horrifies me, because how on earth are you renting it out without the EPC? But anyway, it's a legal requirement to have an EPC certificate. Over 30% of landlords believe the minimum energy rating is an A or B, which is actually higher than the level that is required. So there's also, for those of you who do understand it, a bunch of you don't have the sort of kind of facts correct. Landlords do value help in identifying cost-effective home improvements and finding grants and financing. Something to think about. Some of you who are kind of thinking about energy efficiency and career moves, becoming an energy efficiency advisor for landlords could be a really great thing. We'll see if we can find someone who will do a webinar to kind of talk about quick wins for energy efficiency for properties as we face the changing EPC requirements going forwards. 28% of landlords with an EPC D rating plan to sell their properties, they're just thinking actually too hard bucket, too expensive, don't understand what the exemptions are going to be, I'm just going to get rid of it. So if you've got an EPC rating of D or below, 28% of you are actually thinking about selling it. As we've just talked about previously though, it's actually not that easy just to simply sell at the moment. So maybe worth just, instead of throwing in the towel, doing some research, looking at how you can make those improvements. If you need any help financing it, give us a shout. We're very happy to help you with that, and keeping the property on instead. 73% are unsure of how much money is needed to improve their property. 41% plan to raise rent. So fair enough, actually, if I'm going to make your rental property more energy efficient, save you money on your bills, you're going to have to contribute to that by putting your rent up a little bit. But the 73% who are unsure how much it's going to cost them is the one that worries me. As we know, some EPC changes can be something as simple as putting LED light bulbs in. Some of them can be really, really expensive, so definitely worth investigating. If you get an EPC certificate, actually when you look at the certificate, it does kind of give you recommended works to bring your EPC rating up, so that might be something just to have a dig into. So there you go. Actually what this really shows is how badly the whole kind of EPC piece has been managed by the government, to the fact that there are so many landlords who are uncertain about these things. If this had been done properly in the first place, landlords would simply understand the rules, what was required and what they need to do to kind of improve things. So I think that's on not our current government actually, but also the previous government as well, but really kind of demonstrates how much support landlords need in this space, and particularly going forwards as we go into the next wave of changes for EPCs. And finally, ending things on a high with the Renters' Rights Bill. So the good news, if you see it in that way, is that the Renters' Rights Bill won't be passed until the autumn now. There simply isn't time. The government has published a set of 6 amendments ahead of the report stage, which started yesterday. So there are some kind of amendments that are going to be put into the bill. So I'm just going to run through these really quickly for you. I'm sure we'll do an article on it at some stage, because these are all really, really important. So first of all, there's been a withdrawal of pet insurance. So essentially, some landlords are saying, well, okay, if I'm going to have to accept having pets in the property, the tenant's going to have to take out pet insurance to cover it. That's actually been ruled out. So it kind of leaves the question is, well, what do landlords do to kind of give themselves some kind of security in case Max the Rottweiler tears up the carpet or something. So one of the ways left for landlords to mitigate the increased risk is to charge a pet rent, and that's being considered at the moment. So essentially, if you're going to have a pet in the property, we're going to charge you rent for the pet, but that may go sort of south as a plan if it then ultimately took the overall rent above market rent. So there's deliberations going on about this at the moment. So that's very, very frustrating for people, because I know the pet thing is a real bone of contention for landlords. I do understand, like I've said in previous episodes, personally I don't have a problem with people having pets in properties. We're a big pet household. So I personally haven't had any bad experiences, but I know that there are lots of landlords who have. So I'm not diminishing that by any stretch of the imagination. Other significant amendments. So new transition arrangements for existing tenancies with rent in advance, which is going to be great news for letting agents and landlords with tenancies where rents are payable in lump sum. So there's going to be some arrangements there for those guys. Sensible amendments on notice to quit for joint tenants, potential can use for providers of student accommodation who belong to Unipol or ANUK. A glimmer of hope that the rules will be changed and when rent will be increased after a tribunal referral, and the dropping of the need for council to give prior notice to an owner of a suspected residential tenancy before exercising their rights of entry if the council suspects a breach of database rules, unlawful eviction or harassment of occupiers. So what I would say about these amendments is they're not really something that's going to be majorly exciting for the average landlord, but for some of you actually, and because everyone's situation is so different and the kinds of tenancies that we do are different, everyone's got their own kind of things that they're worried about, so this could be good news for at least some of you. Wow, what a busy week it's been in terms of news stories. Sorry I've delivered that really, really quickly, but I was conscious there was a lot to get through in not a lot of time. So all that's left for me to do is thank you as always for joining us this week. We hope you found that helpful. And as always, our phone lines are very much open if you'd like to give us a call, 0345 345 6788. Keep cool, look after yourselves. I'll see you same time again next week. In fact, no, I won't actually. I've just remembered I'm not here next week. I'm going to Budapest. So I'll see you the week after. So apologies for me, no MFB news next week, but there will be one the week after. Take care of yourselves and I'll see you then.